All right, let's start. Okay. We generally wait for 2 minutes and then we generally wait for 10 minutes and then we start. Okay. 10 minutes is just to let everyone join. Okay. All right. Today we have to do the second chapter, which is second chapter of your book number 3, which is your corporate issuers. Basically, here we'll talk about your investors and your other stakeholders, right? See, when you think about corporate issuer chapter, mostly it is theoretical chapters, right? And easy chapters, right? Corporate issuer is very easy to score marks, right? Again, the logic here is if you look at the bigger picture, right? The module here is stakeholders and ESG factors. Basically, we want to understand that when you look at the corporate issuers, who provides capital to a company, who are the stakeholders, what do they want, what are their expectations, how does their financing choices change your risk and returns, right? That's what we want to understand. And before we even start studying your ESG, CFA wants you to understand, or CFA wants you to keep few things in your mind, right? Such as what is the difference between debt versus equity? What is the difference between ROE and ROA? How leverage magnifies your ROE, return on equity? Why shareholders and debt holders often kind of disagree, right? So that's what we need to understand here, okay? So easy chapter, let's start, okay? So the first part is, okay, there are 8 topics. I think first 2-3 topics are a little tricky. After that, all the topics are very, very easy, right? So, first 2 topics, I think, will take much of your time. Otherwise, there's nothing here, right? Okay. We'll understand difference between lenders and shareholders. How do you do company valuation? Stakeholder of a corporation, ESG factors of your corporate issuers, environmental factor, social factor, governance. You know that these are very basic in like a civics class, and evaluation of your ESG risk. Okay. All right. Here we start. Here it is a little tricky. If at all a question will come from this chapter in exam, it will come from here, right? So when we talk about lenders and shareholders, please understand when we talk about lenders, lenders are your debt holders. Debt holders are basically your debt investors. What do they get? Debt holders get the fixed interest payments, right? Like debt holders, in case of bankruptcy, debt holders have a priority on the getting the payments back, return of your principal, priority claim over equity in bankruptcy. Since debt holders' upside is capped, they only care about whether the firm can repay their debt on time. Is there a stability of cash flow? Is there higher risk or lower risk? They want lower risk. Debt is cheaper than your equity because it is less risky. This line is very important. CFA generally asks this line. Debt is less costly form of capital because it is considered less risky than equity. Okay. Why it is considered less risky than equity? Because debt is all about your contractual payments. That is all about there is seniority in liquidation, bankruptcy. There is no upside participation, lower required return. And we look at the next part, which is your equity holders and shareholders. Equity holder and shareholder gets what is their residual claim, right? Whatever is left after debt is repaid is called a residual claim. Dividends are not guaranteed, right? And your equity or shareholders generally look for a capital appreciation, right? What they care about is growth. What they care about risk taking that increases the firm's value. What they care about the upside potential. So equity has no fixed payments, highest risk, and unlimited upside, right? So the similarity between debt and equity is that both can lose 100% of investment if firm fails, but for whatever reason, right? Losses are limited to amount invested. There's no personal liability for anyone, either your debt holder or your shareholder, right? Key difference between debt holders and shareholders, which you need to understand very clearly, is that when you look at upside, debt is kind of capped. You get interest plus principal, risk is lower, your priority is higher, and your return appreciation is return expectation is kind of lower. Debt has limited upside and equity absorbs both your upside and downside. There's a conflict between your debt and equity that you need to understand. Why conflict exists? Because risk preferences are different, right? Equity holders prefer higher leverage, riskier products, more debt to avoid dilution. Debt holders prefer lower leverage, stable cash flows, protection against risk. And that is why we have something called debt governance also, right? So you will see debt governance also that you should be aware of. So debt governance means that there are conditions such as maximum leverage ratio, minimum interest rate coverage, restrictions on dividends or new debt. So in CFA exam, they love to ask you, why do your debt uh, takers, right? Why do the lenders impose the covenants on debt holders? Why they want to impose covenants on debt holders? Because you want to limit your risk shifting by the equity holders, right? You don't want, if you don't put covenants, people can shift the risk, right? Which you don't want, okay? All right, so remember that may conflict, equity holders are different choice, oppose each other's action, usually limit borrower's action by including contractual provisions such as these ratios, right? Equity holders may oppose such action because higher company risk does not increase their expected return, right? Existing debt holders, right? And yeah, equity holders may support higher risk, higher growth. They want to boost their leverage and growth potential, etc. Okay. Then we talk about company's valuation. This is the only part which is tricky in this chapter, guys. So here we'll talk about your firm value. Firm value is nothing but a sum of your debts and equity, right? That you need to understand. This is not your accounting value. This is your economic value, right? Now the question comes is, what happens when the firm value changes? You can take different cases. Uh, let's say the firm value goes above your debt, right? Let's say the firm value goes above your debt. So debt payoff will stay fixed in that case. All upside goes to equity, and equity behaves like a call option on your firm value, right? You have not studied options till now, but just keep in mind that when something goes up, the call option goes up, right? So call option benefits when the market goes up, right? So I'm taking different cases. Case A is that your firm value goes up. If firm value goes up above your debt, right? I mean, it goes above debt. If it goes above debt, your debt payoff stays fixed, right? Your all upside will go to equity, and equity behaves like a call option, that we should know, right? And but when a firm values go below debt, which is your, this is case A, this is case B, right? Equity becomes kind of worthless. Debt value falls below the promised payoff, and losses are shared, but equity gets wiped out first. Equity is basically your residual claim, right? Which is paid to you after everything has gone out to the, whatever left is gone out to the debt payment, right? You have to understand the impact of leverage on ROE. This is very, very important. Return on equity. Example given here is revenue has been given as your 1,000. Your operating expenses has been given as 800. Your EBIT, right? EBIT. So EBIT, obviously, this is 1,000. This is 800. Asset can be 100% equity or mix of 50-50 debt and equity. The interest rate is 10%. Assume no action, calculate the ROE, right? So when you subtract your revenue minus operating expense, you get EBIT. Assets you're required to invest is 1,000. Okay. Interest rate is 10%. There are no taxes, right? This is what the question is, right? So when this is the question, now you have case one. Case one is equity finance, everything. So what happens here is with equity finance, interest expense is 0, so there is no debt, right? ROE will be what? Net income is 200, 200 divided by 1000, which is basically 20%, right? But when you have interest expense, which is debt is finance, the debt income is your, let's say debt is 500. So interest at 10% is 50, right? So that interest expense is here, right? So net income is 150. Equity is 500 because half equity was 500, debt was 500, right? So now your formula will be what? You will have 150 as your net income. So it will be 150, right? Above, right? Your 500, right? So leverage kinds of increase your ROE, right? As long as leverage increases ROE, as long as return on asset is greater than your cost of debt. Right? Very, very important, guys. Increasing leverage increases your risk, but can enhance return to equity as long as expected return on asset exceeds the expected cost of debt. Return on asset greater than cost of debt. So that if you have that, you are able to get more return on equity. If asset returns meet or surpass borrowing costs, equity holders gain from the added risk, while debt holders receive only the fixed interest and principal, right? So equity holders benefit from your more risk, right? Till the time your return on asset is greater than your cost of debt. Okay, very, very important to understand. This is the only tricky part in this chapter. Another example here is, it's a company valuation again. The revenue has fallen down to now 850, gone down to 850, right? Revenue has decreased by 15%, so 850 because 1,150 has gone. Now, if you take the 100% equity finance, right, then what is the logic here is that you have revenue 850, cash operating expenses 800, 850 minus 850, 50 by 1000, right, 5%, 50 by 1000, 5%, right? But 850, 800, interest expense 50, 0. So here you are getting 0. So what you are realizing here is that same business shock, right? In both cases, whether you are equity finance or you are 50% debt and equity finance, same business shock, much worse outcome when you have leverage, right? You see, when you have leverage, your ROE is so less, right? Here the ROE was at least 5%, na? So the logic is same business shock, right? Same business shock, much worse equity outcome under leverage. Okay, so remember that, right? Very, very important. This is the only tricky part, guys. Otherwise, this chapter is super easy. Okay, let's do the question. This will give you more idea. Again, let's do the question. Consider a firm with assets of 200. Okay, assets are given 200. Fully financed by equity, right? An analytical firm financed with 80% debt and 20% equity, right? So if I take equity only firm, right? Net income, what is their net income of equity only? Assume both firms have revenue over a period of over a period of 200 and non-debt operating expense of 140. So again, net income is what? Revenue minus your operating expenses. Revenue was 200, operating expense was 140. So your net income is 60, right? Now, since it is all equity, right? And equity, the value of equity is what? The value of equity is 200, na? So if I have to calculate your ROE in this case, right, it is 60 by 200. Basically, net income by your equity. If this is equity only, if I am taking 80% debt firm, right, then please understand your interest, you have to also calculate interest is equal to what? 160 and interest rate 20% from the period. So 20% you have taken, which is 32 is the interest. Okay. Net income is equal to 60, which you got revenue minus OE, right? Net income you got, minus you have to do your 32 also, this interest also. So you get 28. But the point here is, what is the equity here? See, 80% is debt finance, right? So out of 200, 160 was debt, 40 was equity. So what is it? 28 by 40, which is 70%. Okay. So again, lesson we get here is leverage magnifies your return to equity. Till the time return on asset is greater than cost of capital, right? So that's what we understand. Again, same question, we have done it again, but go back, practice it. Next one. And same logic has been done here. If you see, they made a table, but I did directly. Right? This was 60, 60 by 230. It was your subtraction 60. I took it 20 by 60, 60 by 30, 28, 28 by 47, right? And this is what we get. Then we have your practice question. So consider a firm with assets of 200 fully financed by equity and identical firm financed by 80% debt and 20% equity. Again, same. Both firms have revenue of 200 and so and so. Calculate return on equity for the period the firm experienced a 20% increase and decrease in revenue from question 1, assuming operating expense remains same. So again, the logic here is different. Now what we are saying is 20% increase in revenue, 20% decrease in revenue. So let's say in one case, 20% increase, let's say. If there 20% increase in revenue, 20% increase means 200 into your 1.2 becomes 240, right? So if it is equity only now, okay, so net income is equal to 240 minus 140 is equal to 100. So ROE is what? 100, or equity was what? Equity was 200, no? So 50%, right? If you are leveraged, net income is what? Net income is obviously your 100, whatever you got from here, minus 32, which is your interest, right? So it is 68. So ROE is what? 68 by 40 equal to 170, right? So massive upside for your equity holders. For your okay, this is one case, 20% increase in revenue. In case there are 20% decrease in revenue, what we will do? If there is a 20% decrease in revenue if you have equity only, right? Net income, your 20, right? Okay. So ROE, right? ROE is equal to 10%, right? So you're not taking uh, how are you getting a net income 20 if somebody is getting a doubt? You had 200 earlier, you're down by 20% means 0.8. So your revenue is 160. This is revenue. Your operating expense is 140. That brings net income 20, ROE 10%. Right? ROE 10% is what? Net income 20, right? Divided by 200. That makes it 10%. There was less space, so I've done it quickly. If your leverage is the only confusing piece in this chapter, guys. If your leverage, net income is equal to what? Obviously, 20 you have taken here. You still use the same 20, but minus 32 minus 12. 32 is the interest expense. ROE is what? Minus 12, right? But divided by what? Your equity, right? If your equity you are talking about, right? What will happen here is that equity is, what is the equity value, guys, here? Any thoughts? What should be the equity value here? 40, na? This was the 40, which was the equity value, na? Make it 30%. So tricky, right? Guys, please go back, understand it, right? Little tricky, but you have to solve this, right? This is the only difficult part here in this chapter, right? Same, look at the table. Tables are much beautiful, but again, in exam, you can't build the table. You have to do fast little bit. I have done that way, right? You can see 10% and 30%. Okay, leverage. Okay. Then another tricky question. These three are the only difficult questions in exam, guys. The rest are all easy stuff. I'm spending time here. This chapter is easy, right? Overall, till now, what we have seen is that debt lowers your WACC, that weighted average cost of capital, but increases your equity risk. Leverage amplifies your ROE, both upward and downward. Equity benefits from upside, you know, absorbs your downside. Debt holders gain no upside from your firm growth. Conflicts lead to your debt covenants. Equity behaves like call option of firm value, right? When we go to your question number 3, right? Another interesting question, right? So here you are considering a firm with assets of 200, financed by equity, analytical firm financed by 80. But again, same question. I'm not doing it again because it's same question. I think both firms have revenue or period 200, non-debt operating 140, same logic. Then the same all equity finance firm as in question 1, and its choices for financing a new investment in, LT assets of 40. The pertinent details in the firm initial balance sheet are shown below. Revenues before the investment 200, operating expense 140, effective remain unchanged. Calculate on new debt financing 20%, return on the new investment 30%. Calculate the ROE for the firm it finances the investment with debt. The issuance of new shares of cash on hand, compare the result, discuss the results of the comparative. Okay, long thing. We have discussed it already, half of them, or 75% of that, right? But let's read the answer. You have to go and practice. Basically, idea here is financing the investment with new shares uh, produce the lowest ROE among the 3 financing options. However, since the investment produced a return equal to the beginning ROE, there was no change in ROE from the initial case. So financing with debt produced a higher ROE because the interest rate on debt was lower than the return on the new investment and no new shares were issued. Highest ROE is produced by using excessive cash on hand. You avoid both dilution and interest rate also debt. Okay, remember this. Highest ROE giving excess cash on hand. This answer is a little bit theoretical, so remember that, right? All right, so we have done the difficult part, guys. This was tricky. Now we have very easy stuff, right? Very easy stuff. We'll finish in 15, 20 minutes. Stakeholder of a corporation. Who are the stakeholder corporation? Stakeholder theory says consider conflicts among several groups that have an interest in the firm's activities and performance. The primary stakeholders of corporation include shareholders, which have a residual interest, claim to net assets after liability. They have voting rights to elect the board and for other corporate matters, giving them control of the firm and its management. They are interested in ongoing profitability and growth. Then we have your lenders and debt holders, which supply your debt capital, right? Loans. They can be your public debt holders, bond holders, or private debt holders, bank, extending losses, etc. Their interests are protected by covenants in debt agreements. Bondholders rely only on your public information and have little influence over operations, while private debt holders may have access to non-public information also. Okay, very easy, very theoretical. Then we have, again, more discussion on stakeholder of a corporation, board of directors. So what we have seen is that your shareholders are the stakeholders, your lenders, debt holders are the stakeholders. The board of directors are responsible for protecting your shareholder interest, setting senior management composition. Remember that. This is asked in exam, establishing strategic direction and monitoring financial performance. They include inside and independent directors, while inside directors may have conflict of interest with shareholders. Independent directors may better protect shareholder interest, right? That's why there is a demand for having independent directors in the sixth chapter. In a one-tier board structure, both inside independent directors serve on original board or single board. Major stock exchanges specify requirements such as director independence, diversity, and competencies. In Europe, boards have a two-tier structure in which the independent directors serve as a supervisory board that oversees a management board comprising insider directors that you need to remember. Typically, board members are elected, or typically board members are elected for a specified term, example annual. In a staggered board, only a fraction of the board is elected every year. This decreases the power of shareholder to enact the major overall of the board. Firms with staggered board justify them as providing continuity and allowing them for a longer term view of the company strategy, right? Again, a lot of theory, just need to understand it in a pure GK word, right? Then we have your stakeholders of a corporation. We have senior managers. Their interests include your continued employment, you are maximizing total compensation, their compensation often tied to firm performance, aligning the interest with the firm's financial success. And look at your other employees, which provide you labor and skills, are the company's human capital. They're interested in firm sustainability, success, pay rate, career advancement, training, and working conditions. Then we have suppliers in providing an ongoing relationship, customers for high quality goods or services, reasonable price, government regulations, rely on cooperation for tax revenue, economic growth, social welfare, employment, regulator, ensure compliance with your laws, right? Okay, so, all right, let's do the question, guys. The company has developed a long-term relationship with its major supplier. The supplier has developed complex systems that integrate with those of the company and has agreement to receive payment within 30 days of period delivered. Discuss the supplier's stakeholder relationship with the firm. Why would high financial leverage be inconsistent with supplier's mandate, right? Again, it's a discussion, not a MCQ kind of thing. So let's read the answer. The idea here is that supplier has a clear vested interest in the success and survival of the company, so it is considered a stakeholder. That is fine. The supplier extends short-term credit to the company and has a long-term interest in the success of the company because it is invested in integrated complex system. High financial leverage would not be the best interest of the supplier, that you remember. Right? That's why it is wrong, because it presents both short-term risk that the company may be unable to make payments for goods delivered and long-term risk for the investment made to integrate the supplier's complex system with those of the company, right? So, as we discussed, right? High financial leverage, not good for supplier because It presents both your short-term risk and company may be unable to make payments for good in the longer run. Okay. Then we move on. Again, explanation question, nothing to worry. Explain why company management might not act in the best interest of shareholder, right? Again, they are bound by certain rules and regulation, which might be against the shareholders. So idea here is managers are in a principal agent relationship with the company shareholder. Managers overseen by the board of directors serve as agents who act in the best interest of company shareholder. However, in some cases, managers may put their own interest instead of shareholder interest. Example, including insufficient effort, failure to take appropriate risk, oversight by majority independence board, and compensation to align your manager's interest with shareholder. With a performance-based and equity-based compensation schemes are mechanics to mitigate this conflict of interest, right? So alignment of behavior, performance-based, equity-based, right? These are mechanics to mitigate this conflict of interest. Okay. All right. Next is ESG factors of corporate issues. Very quickly, very simple. Debt and equity investors are interested in evaluating companies' ESG also. Due to three reasons. One is the government stakeholders prioritize the climate change and social policy through your regulatory changes. A lot of things are happening, green energy, etc. India also. ESG factor can impact the company's result through loss of customer goodwill and financial losses, define judgment, poor customer. Corporate governance may lead to senior manager exploiting shareholders to advance personal interest. Many young investors increasingly manage their wealth with ESG consideration in mind. There are negative externalities arise when a manager or its investor do not bear the full cost of the scheme. Environmental damage, increased government regulation and stakeholder awareness allows companies to accept the financial laws, etc. Okay. Next one is environmental factor, right? Very easy, guys. Environmental factors can be what? Climate change, air and water pollution, deforestation, energy, waste management, right? Material environmental factors impact a company's operation or business model. Company face physical risk, adverse effect from severe weather and transition risk, switching from high carbon to low carbon activities, due to regulation, customer choices, consumer choices. Stranded assets become unviable due to these changes. Poor safety policy increase risk of adverse event, oil spills and groundwater contamination, leading to significant cost from penalties. Stricter regulation and greater stakeholder awareness force firms to account for the cost of negative externalities such as environmental damage that they previously did not fully bear. Right? Overall, environmental factors, I don't think CFA has ever asked these questions. Okay, then we have social factor. Again, I told you, right? First two, three were difficult. These are very easy. Social factors. Social factors contribute to company's image, again, how it treats employees, your Instagram, LinkedIn, etc. Key social factors include protection of customer privacy, information security, customer satisfaction, employee engagement, diversity and inclusion, labor relation, community relation, right? Taking measure to decrease social risk can reduce a company's cost of lending, cost of leading to higher employee productivity, lower turnover, increase customer loyalty, reduce risk of litigation. So if you solve the social risk, you get other advantages also. Okay, next is governance. Again, I told you very simple. Corporate governance encompasses factors that ensure managers should act ethically, lawfully, trust of shareholders. These factors include composition of the board and the internal audit committee, executive compensation, bribery and corruption, political contributions and lobbying, right? So you, when you look at the corporate governance, you have to understand the composition of the board and the internal audit committee. Your executive compensation, this is asked, guys. This is very important. Remember this 4th point. Composition of the board and the internal audit committee, executive compensation, bribery and corruption, and political contributions and lobbying. Okay. Then we have your evaluation of ESG risk. There is an analyst focus. Analyst evaluates a company's exposure to environmental, social, and governance risk and how this may affect its future cash flow. Investor exposure. Equity investors are worse impacted from adverse outcomes. Debt investors have least exposure unless the losses are significant enough to cause a default. Time horizon. Longer maturity debt investors may be more exposed to ESG risks, such as plant becoming obsolete in the future than the short-term debt investor. So again, longer maturity debt investor may be more exposed. Okay. Then we have finished, right? Cool. right? Again, this chapter is very easy. It's very, very easy chapter. How much time we have taken? 35 minutes. Very easy. Only thing is that in this chapter, if you see 10 topics, right? You see 10 topics, right? Don't waste your time, right? Only this topic, right? Company valuation. This is tricky. Right? This is, you have to take both type of value. You have to take equity only, structure, and equity plus debt. This is tricky. Otherwise, evaluation of ESG race, governance, social, environmental, ESG factor, corporate issuer, nothing, right? Super easy. 4 to 8 are super easy. Right? You can casually read, finish it very fast. Right? Third one is little detailed, but again, not that difficult. Here you have to understand, okay, that what are the different stakeholders, suppliers, vendors, your shareholders, lenders, right? All those things, right? Company valuation tricky, lenders and shareholder, what is the difference between their thought process that you have to understand, right? So difference in thought process. Your lenders want safety, right? Less risk. The shareholder wants more risk, right? That we need to understand. I think this company valuation, this is tricky. That's why we have solved the numerical. I told you, right? This is tricky. This will trouble you a lot. So uh, you know, try to solving it at home, right? That's the idea. Okay. After that, the stakeholder very easy: shareholder, lenders, board of directors, right? Your senior managers, other employees, suppliers, customers, government and regulation, etc. Right? This is like a story question. ESG factor of corporate issuers. Please understand. Government should prioritize. ESG factor can impact company result. Younger investor greatly manage their own money. Negative externalities when company or investor do not bear the full cost of its action. Right. So let's say there is a oil, slippage in the sea. Right. So if your company is not bearing the cost of cleanliness, etc., that's wrong. Right. Increase government regulation and stakeholder awareness and state companies to recognize these costs either explicitly in the finance statement or implicitly. Right. So that's what we want. Right. Environmental factors given very clearly 5. Right. Material investment factor impact a company's operation or business model. Company face physical risk. Standard assets become unviable. Sector regulations. The social factors very easy again. 6 points. Right? Talks have agreed in school, right? That you have to take measures to decrease the social risk, can reduce your company's cost by leading to higher employee productivity, low turnover, increase customer loyalty, reduce risk of litigation. Then you have your governance, right? Which is ethically 4 points, remember, right? Governance means you have to consider composition of a board, internal audit committee, executive composition, bribery and corruption, political contribution and lobbying. Right? Evaluation of ESG risk is easy, right? So we have again seen the chapter quickly, but you understood, right? There is 2, 3 slides which are tricky. Otherwise, casual reading. Okay. Any doubt? Nida, any doubt?
No, sir, not for me, but I will have to go through once
Yeah,
with the
just go.
slides when it's updated in the notes. Yeah.
Yeah, sure. Go again. Just spend some time in this.
Corporate
Yeah,
valuation.
that small thing is there, right? Just spend some time here and remember that highest ROE, right, is using
Mm-hmm.
excessive cash on hand, right? Second highest is obviously by debt. Least highest is when you do it only with equity, right? So that and this calculation part, just be aware of that, right? Okay.
Yes.
All right, guys. Let's stop here and see you tomorrow. Okay. Thank you.